Hello, everybody. Welcome to Clever Investments. Today, let's finish talking about the buy and hold strategy. So, this is the most important investment strategy that this channel recommends, which is buy and hold US broad market index. And we have spent several videos talk about why. So, we want to pick the US stock market, which is the best stock market, and we want to buy and hold broad market index because we don't want to play the zero-sum game against professionals when we pick stocks or time the market. That also avoid tax. So when you buy, you use dollar cost average. We discussed this in the previous 6 videos from 96 to 101. And you may ask the question, okay, I buy and hold, but what's next? When do I sell? So in principle, if you need to pay tax when you sell, you do not sell because this avoids a very high tax, which is up to 37.1% in California. If you sell, you lose that amount of money permanently to the government. And even when I die, I don't sell. So if I don't sell the stock, how do I use the money in the stock account? And there's a popular strategy called buy, borrow, die, which means you buy and hold the stock forever, literally forever. You borrow money against it using stock banked loan or margin loan or whatever name your broker gives. You borrow against your stock and you pay interest. When you borrow money, you don't pay tax, so you save the tax. And then, as long as you don't borrow too much, the stock will grow faster than your loan, so that you will never need to pay back the loan. And this channel recommends a better method using similar strategies as buy, borrow, die, and I call it buy and box. So basically, you still buy and hold the stock index. That part is the same as buy, borrow, die. But you borrow money with the short box, as we explained in many of our former videos. See this playlist. So you borrow with box, which can generate capital loss, because when you borrow money using box, all the interest you pay are capital loss. And similarly, if your stock grows faster than your loan amount, you also never need to pay back the loan. You just renew the loan. You generate a new box and borrow again. And because box generates capital loss, you can sell just enough stock to generate equal amount of capital gain so that your capital loss is canceled out. And that means now you are selling without paying any capital gain tax. That can generate a lot of savings in the tax. And the benefits of box is it has a lower interest rate compared to any kind of stock banked loan you can use from buy, borrow, die. Because the box, the interest rate is only slightly higher than the federal rate. And because you sell stock to pay back some of your loan, and you sell it tax-free, this reduces your leverage compared to the buy, borrow, die. And with less leverage, you get less risk. So the disadvantage of buy and box compared to buy, borrow, die is because you have less leverage, you sold some stocks, your total return is slightly less. But if we are doing this with the benefit of a lower risk, it's totally worthwhile. I have several earlier videos discuss this, compare you directly sell and pay tax, the buy, borrow, die, or use box to reduce your leverage. And episode 17 is one of the video. There are also several other videos discussing this similar topic. So if I never sell, what happens when I pass away? In that case, my stock account is passed to my kids, but after they pay the estate tax. So estate tax has an exemption. Basically, each person has 14 million, and for a couple, the exemption amount is 28 million. That means as long as your stock account is less than 28 million, you don't pay any estate tax. And this 28 million is not fixed. Likely it's gonna increase every year based on inflation. So if you think your stock account can never grow beyond this amount, you don't need to worry about estate tax. But if you do, there are many other ways that can help you reduce estate tax, which was discussed in some earlier videos. And also, there is an important cost basis step up rule. Let's use an example to explain this rule. Assume you bought the stock index when it is $100 per share. And when the owner passed away, it already increased to $1,000 per share. That means each share has $900 of capital gain. If you sell, you own $900 per share of long-term capital gain tax to the government. But if you don't sell, you pass the stock account directly as estate. Then the cost basis of the share will become 1,000, which is the price of the index on the day the owner passed away. So that means this $900 capital gain tax will no longer need to be paid because it was never sold. So this means you saved the capital gain tax along the way, and once it becomes estate, when it passed to the children, then the children, the new owners, never need to worry about the capital gain because they already paid the estate tax. Or in the case of the stock account less than $28 million, they don't need to pay any estate tax. Okay, that's all for today. Thank you.